Hello guys, welcome back to my channel. Today we are going to talk about what is a bond. A bond is a fixed income instrument that represents a loan made by an investor to borrow a typically corporate or governmental. A bond could be thought of as an IOU between the lender and borrower that includes the details of the loan and its payments. Bonds are issued by companies, municipalities, states, and sovereign governments to finance objects and operations. Owners of bonds are debt holders or creditors of the issuer. Bond details include the end date when the principal of the loan is due to pay to the bond owner and usually include the terms for variable or fixed interest payments made by the borrower. Who issues the bond? Bonds are debt instruments and represent loans made to the issuer. Governments at all levels and corporations commonly use bonds are in order to borrow money. Governments needs to fund roads, schools, dams or another infrastructure. The sudden expense of war may also demand the need to raise funds. Similarly, corporations will often borrow to grow their business, to buy property and equipment, to undertake profitable projects for research and development, or to hire employees. The problem that large organizations run into is that they typically need far more money than the average bank can provide. Bonds provide a solution by allowing many individual investors to assume that the role of the leader indeed. Public debt markets let thousands of investors each lend a portion of the capital needed. Moreover, markets allow lenders to sell their bonds in other investors or to buy bonds from other individuals. Lenders to sell their bond to other investors or to buy bonds from other individuals. Long after the originally issuing organization raised capital, how bonds work. Bonds are commonly referred to as fixed income securities and are one of the main asset classes not individual investors are usually familiar with, along with stocks, equities, and cash equivalents. When companies or other entities need to take raise money to finance new projects, maintains ongoing operations, or refinance existing debts, they may issue bonds directly to investors. Borrower issues a bond that includes the terms of the loan. Interest payments that will be made and the time at which the loan funds must be paid back. The interest payment is part of the return that bondholders earn for loaning their funds to the issuer. The interest rate that determines the payment is called the coupon rate. The initial price of most bonds is typically set at par or $1,000 face value per individual bond. The actual market price of a bond depends on a number of the factors: the credit equality of the issuer, the length of time until expiration, and the coupon rate compared to the general interest rate environment at the time. The face value of the bond is that will be paid back to the borrower once the bond matures. Most bonds can be sold by the initial bondholder to another investors after they have been issued. In other words, a bond investor does not have to hold a bond all the way through to its maturity date. It is also common for bonds to be repurchased by the borrower if interest rate declines or if the browser's credit has improved, and it can reissue new bonds at a lower cost. Advantages and disadvantages of bonds. Advantages: receive income through the interest payments, hold the bond to maturity and get all your principal back, profit if you resell the bond at a higher price. Disadvantages: bonds may out lower returns than stocks. Companies can default on your bonds, bond yields can fall. Characteristics of bonds. Fact Face value is the money amount that bond will be worth at maturity. It is also the reference amount of the bond issuer uses when calculating interest payments. For example, say an investor purchases a bond at a premium of $1,090 and another investor buys the same bond later, and when it's trading at a discount for $980. When the bond matures, both investors will receive an 1000 face value of the bond. The coupon rate is the rate of interest bond issuer will pay on the face value of the bond expressed as a percentage. For example, 5% coupon rate means the bondholders will receive 5% multiplied by 1000 face value is equals to $50 every year. Coupon dates are the dates on which the bond issuer will make interest payments. Payments can be made in any interval, but the standard is semi-manual payments. The maturity date is the date on which the bond will mature, and the bond issuer will pay the bondholder the face value of the bond. The issue price is the price at which the bond issuer originally sells the bond. In many cases, bonds are issued at par. Two features of a bond: credit equality and time to maturity, and are the principal determinants of a bond's coupon rate. If the issue has poor credit rating, the risk of default is great, and these bonds may pay more interest. Bonds that have a very long maturity date also usually pay a higher interest rate. This higher compensation is because the bondholder is more exposed to interest rate and inflation risk for an extended period. Credit ratings for a company and its bonds are generated by credit rating agencies like Standard and Poor's, Moody's, and Fitch ratings. The highest quality bonds are called investment grade and include debt issued by the US government and very stable companies such as many utilities. Bonds that are not considered investments grade but are not in default are called high yield or junk bonds. These bonds have a higher risk of default in the future, and investors demand a higher coupon payment to compensate them for that risk. Bonds and bond portfolios will rise or fall in the value as interest rates change. The sensitivity to changes in the interest rate environments called duration. The use of the term duration in this context can be confusing in new bond investors because it does not refer to the length of the time the bond has before maturity. Instead, duration describes how much a bond's price will rise or fall with the change in interest rates. The rate of change of a bonds or bond portfolio sensitivity or to interest rates is called convexity. These factors are difficult to calculate, and the analysis requires is usually done by professionals. So, this is it for today, guys, for bond. I will see you in the next video. Thanks for watching.